Welcome to Kendall Capital, home to the middle-class millionaire. Let's take a moment to show you how we work. Whatever your stage in life, we begin by developing your investment policy statement. This sets out your short and long-term investment goals. We also identify any current constraints you have or expect to have. These can include your need for investment income, quick access to cash when you need it, income, capital gains, and estate tax liabilities, and other issues specific to your situation, like family members with special needs or future inheritances. It ends with an asset allocation strategy we agree on together that is aimed at meeting your objectives. We will review this plan together once a year, or whenever there's a change in markets, laws, regulations, or your goals. Now let's take a look at the big picture of your investment options. You've already saved quite a lot, so you likely know that investing a portion of your income can fall into two major categories: after federal, state, and local taxes have been paid, and before or pre-tax. Going pre-tax gives you more funds to work for you. In pre-tax investments, the taxes on your earnings are deferred until withdrawals are made. After-tax funds can be invested in taxable accounts where taxes are payable as they are earned, tax-deferred accounts, and even tax-free accounts. Of course, any gains we show here are merely for comparison purposes. So far, what we've shown applies to every investor. Where does the personalized strategy come into play? Let's take two couples, for example. They fall into two categories. John and Judy are 57 years old and getting serious about retiring and what that will look like. Bob and Betty are 72-year-old retirees and want to ensure financial stability and a healthy estate for their loved ones. Two couples, two categories. But that's where the generalities end. John and Judy share goals as a couple, but also have individual ones. John plans to work at his $60,000 a year job until age 60, then retire. Judy is a teacher and wants to delay retirement until 67 to get the most from her pension plan. Both are maximizing their savings at work. They'd like to have $15,000 a month after taxes and healthcare costs. Here's the path they're on with their combined taxable and tax-deferred assets. When John retires in a few years, assets continue to grow as Judy works and saves. A few years after Judy retires, assets peak. Their combined Social Security income alone is $60,000 a year, and Judy's pension adds another $40,000 annually. We're using a 7.5% yearly return in this example. But the assets will dwindle and deplete before their plans end, falling short of their income goals just when they're likely to need more, and leaving nothing for heirs and dependents. Here's the plan we worked out together. If John can continue consulting work part-time until age 70, putting away $30,000 a year into an individual 401k, if both he and Judy maximize their Roth IRA contributions and delay collecting Social Security until age 70, using the same rate of return, they will do as much as possible to ensure their future financial security. Now, how can we help Bob and Betty? At 72, they can expect to live another 20 years. Their $6 million in assets consists of $2 million in home equity and $4 million in investments, half taxable, half deferred. Bob's $80,000 a year pension is on top of the couple's $50,000 in yearly Social Security benefits. They can spend $180,000 a year after taxes and health insurance. Great, but can they do better for the estate they hope to leave behind? Currently, they can project an estate value of $8.9 million in 20 years. Not bad. But by taking advantage of currently available asset transfer mechanisms, they can increase that by about 18%. Again, using hypothetical tax and return rates. What mechanisms? First, a conditional transfer into 529 accounts for grandchildren. And second, gradually transferring $500,000 from their IRA to a Roth IRA. Sounds easy, and it is when you have the advisors at Kendall Capital to do the math and apply Kendall's asset growth and protection strategy to your individual needs. And you always have the peace of mind that our fiduciary, fee-only service means our recommendations will always be in your best interest. We're proud of our high client retention. People come and stay with no long-term commitment. And we invite you to learn more and see how Kendall Capital can help you.